You're launching royalties and rewards for diners, but this is something, as you'll admit, your competitors are already doing. DoorDash has a huge partnership with Chase. Why not do this sooner?
Well, the Grubhub Plus program is an order of magnitude more exciting than anything that's out there right now. The free delivery, that's table stakes. What we're doing is 10% cash back, and that's incredible. That is a huge amount of money that we are giving to diners for ordering on our platform. It is an accumulation of the strategy that we outlined in our shareholder letter 6 months ago, which was about supply. We've doubled the restaurants. We have the largest restaurant network in the country, and it's about unparalleled rewards. We have over hundreds of millions of dollars currently available for redemption on our platforms through our perks program, our restaurant loyalty and rewards programs, and then this Grubhub Plus, where we're giving 10% cash back. So we're really leaning into our profits as the only profitable player in the space, and we're leaning into profits to steal share from everyone else in the industry.
Still, your position in the food delivery market has been challenged by upstarts with big pockets, from DoorDash to Postmates to Uber Eats. How worried are you about the competition when they have a lot of cash at their backs?
I don't think they have as much cash as they used to have. As you know, the private market funding, or the private funding market for late stage companies has really dried up post WeWork, and it's very hard to find equity investors to write a $100+ million check. We are profitable, so we can sustain this business for as long as possible. As we said in this shareholder letter, we are cutting back on our profitability to be more competitive and to do things like Grubhub Plus, where we're giving consumers 10% cash back. So we're really attacking from a position of strength. And while everyone else is slashing budgets to try to find profitability, and they're promising profitability later in the year, we have profitability, and we are giving away unparalleled rewards to consumers.
So as you say, Grubhub has been profitable. You reported net income of $1 million on $322 million in revenue for the quarter ending September 30th. But as you just said, you're also willing to sacrifice profits. So are we going to see no profits? Are we going to see losses? What does that mean?
No, we guided the street for 2020. We're going to make $100 million net profit. And that's arbitrary. I mean, we just said, look, we want to make sure that we can prove to everyone that we can still make a substantial amount of money while being as competitive as we can. So we pushed into non-partner delivery. We've doubled our restaurants. We're nearing 400,000 restaurants right now, the largest restaurant network in the country. And then we're doing these programs like Grubhub Plus, where it's free delivery, obviously, 10% cash back, access to elite care teams. We're doubling the donations for all the Donate the Change for Grubhub Plus members. It is an incredible experience that we're throwing everything against the wall. We're pulling out all the stops for consumers because we know we have the best platform and we want to prove it to everyone.
So let's talk about the competition. Obviously, there are a lot of players here. Many people have said that all of these players simply can't survive. Do you see consolidation in this business? And if so, what makes sense?
I think there's a lot. I'd say there's too many players losing too much money. And so something's bound to happen. And we've acquired 10 companies in the past 10 years. So acquisitions is part of our growth strategy. So by being as competitive as possible, by pushing the envelope and stealing share, I think we're creating opportunity to buy companies in 2020.
What kind of companies? Who are you eyeing?
I would say we're opportunistic. We look at everyone. We're aware of the marketplaces. We are aware where people are strong, where people are faltering, and we're looking forward to seeing how the year shakes out. There's a lot of companies that are forced to raise money because they don't have enough runway to operate successfully for the remainder of the year. And so we'll see who's investing where. Like I said, I think the late stage VC market is dry. I think the IPO markets are closing, if not closed, between the coronavirus and the election. I think that for the rest of the year is not going to be strong for IPOs. And so I think there's a lot of tough choices to be made, and we're here to make deals.
You've unequivocally denied a report about selling your own company. Is that still the case?
It's funny. So earlier in the year, I was pushed out of my no comment box by some pretty irresponsible and ridiculous, frankly, rumors. We made the statements. We said we had no plans and we were not in the process to sell the company. I am now officially back in my no comment stage because it's just not a question I really want to answer. But I can tell you this. if you look at a company that's trying to position themselves to be sold, I don't think you're going to see them slashing profitability, being hyper competitive to steal share. If I was positioning a company to be sold, I would be protecting margin. I'd be maximizing the value, the financial value of that company in order to attract potential suitors.
You've got partnerships with some large fast food chains, Yum Brands, KFC, Taco Bell, Shake Shacks. Shake Shack did not have a good earnings report recently, and investors have pointed to their partnership with you as part of the headwinds. What is your response to that?
So we're going to be a great partner for Shake Shack. Specifically, look, they had a rough quarter. I mean, call it for what it is. Delivery is a very small percentage of their business, and they're only exclusive right now for about 25% of their restaurants. So it's 25% of a very small portion of their business. I don't think it's fair to point fingers at us. However, it's going to be a very successful program for them, because for the restaurants that are exclusive, we're delivering thousands of orders every day, and that's growing. We also have a deep integration with their systems. We allow Grubhub diners to cut the line at the Shake Shacks, and we're really driving integrated solutions for that brand that we are willing to invest in because they have gone exclusive with us.
Now, delivering from chains can be less profitable than from independent restaurants, but of course you get potentially higher volumes. What is the balance that you see striking there longer term?
Yeah, it's a great question, and it's something we specifically addressed in our latest shareholder letter, where we said, look, QSR is a loss leader for the industry. It's very valuable to get new diners. It's valuable to satisfy your frequent and repeat diners, but profits aren't going to be made in QSR. We even had a chart in there that says if you're over 35% in your QSR mix, you're just not going to be profitable. Full stop. So what we're saying is, by cultivating the independent restaurant contracts, by providing a valuable service, marketing local restaurants digitally in ways that they can't do themselves, they are willing to pay demand generation fees, and that's where the majority of the economics in my industry will come from now and forever. So the fact that Grub has over 100,000 independent restaurants paying us demand generation is a huge deal, and it is the main reason why we are so profitable and the rest of the industry is not.
Now, you alluded to this earlier, but SoftBank backs some of your competition, DoorDash, Uber Eats. Masayoshi Son is going to be back in New York for the first time since the implosion of WeWork. What's your outlook for some of these SoftBank companies, knowing that they're your competition?
I think that SoftBank really did a disservice to a lot of these startups. I think that they promised them hundreds of millions of dollars over years, and they got companies to make investments they would not otherwise have made if they had been held accountable for the ROI on those decisions. And then all of a sudden, WeWork implodes and SoftBank pulls back, leaving a lot of these companies in a very precarious position because they have to raise money because they are not profitable. The point was not to be profitable, the point was to grow at all costs. So now there's this overhang they have to resolve, and the public markets are not going to accept that. The private equity markets are not going to accept it. I think that they're going to have to turn to debt, which is a very tricky situation. It's putting a gun to your head, especially in a startup that does not have a sustainable economic program.
So let's look a little farther out. Let's say in a year and then in 5 years. What does the food delivery business look like? There's just a lot of skepticism that so many different companies can make the numbers work.
I think that we've proven the numbers can work. There's no question about that. I mean, the real question is how much extra money is going to flood into this marketplace? I don't feel like it's going to be a lot. So you have a lot of players losing a lot of money, and something has to give. 5 years from now, delivery is probably more widespread than it is now. The addressable market for pickup and delivery is around $300 billion in the US alone annually. So I think there's a lot of room to grow. The entire industry probably selling less than $50 billion in food right now. So we can dramatically expand, but the problem is how do the other players reconcile the economics in a way that's sustainable and that they can continue providing a valid service, not losing money with every transaction?